Welcome back to another Rockstar retention video. We're here with our team at MonitorBase. Thank you for joining us today. And our conversation today is really around the topic of credit triggers. It's a very hot topic in the market right now. There's a lot of conversation about it, and we wanted to jump in and have a little chat today about credit triggers. What is the current state of affairs? What are people saying about credit triggers, and why is it coming up like it is in such a dramatic way in 2023?
Well, you may have seen NBA recently has been putting their political influence behind a bill to ban credit triggers. You're also seeing something similar in the broker space that actually has recently been adapted just a little bit to be a ban on credit triggers if you don't have a relationship with the person, which we think is a healthy change. Overall, there's just an industry-wide kind of uproar because as things have gotten tougher in the mortgage industry, there's less business in hand. Competition has become cutthroat, and it's really causing some issues. So that's what's really triggering it in today's space. That very aggressive competition in a down market has pushed the industry to start trying to implement change. And people change when they're suffering or in pain. And that's what we're seeing, I think, right now.
Besides that increased competition, there's some really actual bad behavior from some of these companies buying the bulk mortgage triggers. We hear stories about people getting 10 phone calls right after they take an application with their lender. But the real problem is the deceptive practices that those lenders are using and saying, hey, I'm just calling to finish your application. Or, hey, your LO is no longer in the industry, just crazy, deceptive, non-realistic sort of statements. And that absolutely needs to be addressed.
Well, and if you go into any of the social groups, loan officer, Facebook groups, things like that, you're seeing conversations there. The client is getting, like you said, 10 phone calls in the first hour of that next day. And those phone calls are people pretending to be the loan officer or that loan officer's assistant. They are absolutely lying. They are insinuating, hey, I'm just here to finish that loan application, and gathering information without disclosing who they are. Very aggressive in both how quickly they're reaching out, how aggressively they're reaching out, and then in the actual sales tactics. It's not just like, hey, our clients are being aggressively called. This is like absolutely violating ethics and existing rules around,
Yeah, just do not call, deceptive act and practices rules. Like, it's a bigger problem than people getting access to the triggers, and those things definitely need to be addressed.
Well, and you can imagine how the borrower feels. You just took an application on them. That borrower is, starting something that's a challenging process. And they're now all of a sudden feeling like, oh my gosh, I'm getting all these calls. Did this lender sell my information? What's happening here? Did they lose my information? Like, that's a sense that people are getting. And then on top of that, they're being, the people that are calling them are in a lot of cases really the lowest common denominator in sales and in the industry. And so it's overall giving consumers a bad experience, and they're not feeling taken care of. And that's, I think, what we're seeing a lot of loan officers stepping up and saying. It's like, my clients are worried, and that's just not a space that we want to be in. The problem wasn't as bad 2 years ago because there was a lot more business. We weren't seeing these kinds of activities to the same extent, and that's just the reality of this shift. And one of the reasons we bring it up is because we work in the spaces of credit data, and we see a lot of the not only the unscrupulous behavior, but we see people honestly trying to help. And that's, I think, been our philosophy since, the get-go, Louis.
Yeah. I mean, I started in the industry, almost 20 years ago, and I was young. I didn't have any realtor relationships. So I started at a mortgage company in a call center, and, we weren't necessarily calling triggers, but it was still a call center calling leads and data. Never in that period of time did I think, this is a great business and I want to continue and I want to grow my my professional career doing this. I was more thinking anything I can do to get away from this cold call sort of business model is going to be good for the future. I mean, both originators and consumers don't enjoy having those, doing those cold calls and hearing from somebody, I don't want to talk to you. No, I don't want to talk to you. Why are you calling me? There's so many better ways and smarter ways to do marketing. We've just taken the approach of, hey, rather than try and figure out how to call more and more and more strangers, let's figure out, how do we get some better analytics around the relationships that you have built, and so you can reach out to them when they are in the market. And so really focusing on, your existing relationships, whether that's funded loans or somebody you might have done a partial app for, or just somebody you have a personal relationship with. So that's kind of, we've taken that approach in our product. We really have, we have no interest in adding bulk triggers to the platform because we wouldn't suggest that to a customer. We wouldn't say, hey, let's figure out how you can, mass market strangers that it's just so, cost prohibitive that we really haven't we haven't wanted to take that approach.
Well, and it's always consistently, across any industry, it's cheaper and easier to get more additional business from an existing client than it is to go out and find a new client. And you're seeing that in an extreme situation because you're not just finding a new client with triggers, you're finding a new client in the most competitive space possible. And so for us, we're trying to move people to the philosophy of doing business where they already have that relationship, and then they're 10 steps ahead, and the borrower is actually having a significantly better experience. Now, unfortunately, in the current space that we're in, there is some regulatory roadblocks to making change. And the truth is there are already laws against a lot of these practices that are going on. And when it comes to getting, a change like what's attempting to be passed, there are special interests that are anti-change, right? They want the status quo. And there's a lot of money behind that. So particularly in an election year, we're somewhat skeptical that the law will be able to be passed. On top of that, the bureaus and these resellers that sell these bulk triggers, they have had success in the past because these laws have been proposed like 2007, 2000, and I think it was 16, 18, 20, and 21. Just to name a few of the years that laws very similar to this have been brought up.
And not laws, but bills were introduced, right?
Sorry, bills have been brought up and introduced, but they've not made it, really to the floor. So some of these proposals have merit, particularly when it comes to your underserved or your minority groups, especially in more rural areas. Because, in a metropolitan area, people have lots of offers and options for financing. But oftentimes, there's one bank in this little town, and that client is less likely to get the best terms if there is only one other option for them. And so there are some very good arguments on the bureau side that have stopped changes like this from happening because they can document that the competition has helped, especially these minority groups, get better terms. And so I think what we're seeing here is a shift where, it has to counterbalance the benefit. And that's where I think the new rule that allows for existing relationships to have credit triggers, but not if you don't have an existing relationship, actually really addresses that in a thoughtful way. And we're pretty excited about it. But those are some of the roadblocks that we're seeing to, actually being able to make this change. One of the biggest short-term solutions to this that we're already seeing actually take hold right now, and if you're not seeing it yet at your lender, I bet within the next 6 to 12 months you will. And that is being able to do instant soft pulls and using soft pull credit to run AUS. Though it's not killing triggers, but it's delaying it until much further in the loan process. And that alone is something that lenders can start working on today, this month. And implementing those changes is going to solve so much of this problem. Because if that, any of those deceptive practices that you're seeing that you've probably heard other examples of, if you consider those, but you're calling someone that already has a clear to close because they've already gone through underwriting and gathered all the docs, it's just not going to work. And so, if it ceases working, then a lot of these practices will just stop. It's not economically feasible for them to continue.
Yeah, they won't put the money. The call centers won't put the money or resources behind it if everyone they call is saying, "No, I've got a closing date and I'm ready to go." Right? Like there won't be successes there. But also there's way more that soft pull solves, because we all know that, a home purchase or refinance is not a linear process, right? It's, get started, figure out something that needs to change or be fixed, or wait for a down payment, whatever it is, and then fall out of the process, later come back and try again, right? And so to have those, soft pull or, insta pre-qual kind of products, you can, deliver a credit pre-qualification, run that through automated underwriting, and then the realtors are happy because it's still a solid pre-approval, but you haven't had that hard inquiry. And also there's so many costs related with full tri-merge credit reports now that if you can delay those to the deals that are really moving forward, that's going to save a lot of money.
What are some of the other solutions that we see, especially long term?
So we've never really had interest in bulk trigger sales. Like our philosophy has always been capturing more business from your existing relationships, the clients you've worked with in the past, the people that you already know. And we try and do that with better data analytics. The truth is there's a lot of opportunity there, and most people really underestimate it. 4 out of 5 past mortgage clients go and close their next loan with a different lender. They don't return to that previous lender. So we actually think you have to first change your mindset a little bit to see that there is much more opportunity in the space of your relationships than you're currently giving it credit for. But besides that, a credit trigger is a very reactive alert. They're in the market, and you're going to work really hard. And if you get 10 credit triggers and you get one of those people to come back to you, that's success. But the truth is 9 of those clients were still lost. And so we're trying to reach out into, not trying to, we've been doing some pretty amazing predictive analytics. And that is in an attempt to get out in front of and, frankly, stop delivering credit triggers. We want our predictive alerts to get to you before they start the loan with your competitor. And that kind of analytics is really where we've invested most heavily as a company. And right now, our predictive analytics, most people don't realize it. It's kind of an understated feature. But we predict about 75 to 80% of all of the credit triggers we deliver. We can tell our clients before the credit trigger happens. So to us, that's the way of the future. You're going to see credit triggers reduce as people start utilizing soft pull more. And that's, something has to change, and that's what lenders can do right now, whether the regulations change or not. On our side, we think using, artificial intelligence and the data that is available to you to find those people sooner in the loan process. When they're just starting to discuss listing their home, those are times when clients are the most receptive, and it's the easiest to engage them in a conversation, especially when you have the existing relationship. So that's really been our philosophy and what we've been developing toward, for more than a decade. And, our statistics speak for themselves. We have an incredibly powerful upstream early indicator analytics.
Yeah, and also as an originator, you can imagine how those conversations are much more comfortable and easy for an originator to wrap their head around, instead of calling when somebody's already applied with their bank and not realizing that you also can do an FHA loan or whatever that might be. With the predictive analytics, you're reaching out to reconnect with the person you already know. And it happens to be that a big percentage of those are going to be in the market in the next 90 days. And so you're doing a connection saying, how you doing? Just wanted to follow up, see what are your plans, so that we can make sure that we're here to educate you and get you through, the process once the time comes. And then they'll tell you, yeah, you know what? We're actually starting to think about it. Or they might call you 30 days later because now they're like, hey, that was that was a great conversation. They're here to help me. I should call them, before I go and talk to a new lender that I don't know, right? So, changing the philosophy to let's get the analytics to originators to know when are these behaviors happening that you should re-engage, so it's not on their birthday, or it's not a yearly file review when we have no clue what's going on. It's these behaviors are happening. Let's reconnect. And then you're at the top of their mind in that process over the next month or two when they're actually going to do a transaction.
Well, and there's so much noise. Like, go to your inbox right now. Look at how many spam emails you get, right? How many spam phone calls do you get? And now spam text messages. We're just being inundated with marketing and sales. And even if it's not spam, if it's coming to you at a time when it's not relevant, we ignore it. And so, you can try and get above the noise by being more persistent and more loud. But over time, that just makes people start blocking and unsubscribing and stop following. And so using data to identify who you should be focusing on so that you can be a little bit more persistent at the right time, and then be quiet the other times so they're not unsubscribing, so that you're not getting caught in spam filters, so that they are actually receiving your communication, is really a key strategy, because none of us like the spam, none of us like the cold, persistent, aggressive sales tactics. So that identification process, that analytics is really powerful. It's really necessary. It's just it's a tricky balance, and that's what we're really navigating in today's space.
Yeah, I like the way that you phrase that. It's a very nuanced conversation around credit triggers because, like you mentioned, there is some of that data that can really help some of those underserved individuals to have some healthy competition and get them a better deal for, whether that's a product or a rate or just an experience overall. And at the same time, you don't want to have the consumer have a really bad experience and here you feel that aggression coming from the lending industry. So it is more nuanced than sometimes it can initially come across. But that is kind of our philosophy, as you both had mentioned, is really prioritizing the consumer experience overall. Thank you for joining us today on our MonitorBase Rockstar retention video. Please comment on this video. We'd love to hear your feedback and what you have to say about your lived experience with this issue. Share this video with any of your friends in the industry, and be sure to subscribe to our blog for more information.